Hello everyone, today I will present the overview of the merger and acquisition transaction between IHH Healthcare Berhad and Island Hospital. This acquisition is one of the important corporate expansion strategies in Malaysia's private healthcare industry. Through this transaction, IHH Healthcare aims to strengthen its market position, expand its hospital network, and enhance its medical tourism services, especially in northern Malaysia. First, let us look at the background of both companies. IHH Healthcare Berhad is one of the world's largest private healthcare groups. The company was established in 2010 and is headquartered in Kuala Lumpur, Malaysia. Today, IHH operates hospital and healthcare centres across Malaysia, Singapore, India, China, and Turkey under well-known brands such as Gleneagles Hospital, Pantai Hospital, and Mount Elizabeth Hospital. IHH has continuously expanded its healthcare services through strategic investments and acquisition to improve healthcare accessibility and strengthen its competitive position. On the other hand, Island Hospital is one of the leading private hospitals in Penang. It has been operating since 1996 and is recognized for its specialized medical services, advanced healthcare facilities, and strong reputation in medical tourism. The hospital attracts many international patients, especially from Indonesia and neighboring countries, making it one of the most trusted private hospitals in northern Malaysia. Next is the type of merger and acquisition. The acquisition of Island Hospital by IHH Healthcare is classified as a horizontal acquisition. A horizontal acquisition occurs when one company acquires another company that operates in the same industry and offers similar products or services. Since both IHH Healthcare and Island Hospital are private healthcare providers, this acquisition allows IHH to increase its market share, strengthen its presence in Penang, and further develop its medical tourism business. Now, I will explain about chronology of the transaction. In July 2024, IHH Healthcare announced its plan to acquire about 92% of Island's Hospital's shares. After the announcement, the acquisition went through the regulatory review and approval process. Once the transaction was completed, Island Hospital continued to operate under its own brand. However, it officially became part of IHH Healthcare's hospital network in Malaysia. This acquisition is an important step for IHH to strengthen its presence in the Malaysian private healthcare industry. Next, let me explain the acquiring company and the target company. In this transaction, IHH Healthcare Berhad is the acquiring company because it purchased the shares of Island Hospital. Meanwhile, Island Hospital Sendirian Berhad is the target company because it was acquired by IHH Healthcare. Through this acquisition, IHH plans to expand its hospital network in Penang, improve healthcare services, and attract more medical tourists. Overall, this acquisition supports IHH long-term business growth and strengthens its position as one of the leading private healthcare providers in the region.
So the next part is synergy received from the M&A. The first one is valuation. IHH Healthcare acquired Island Hospital in Penang for 3.92 billion ringgit, approximately USD 896 million, marking one of Malaysia's largest M&A deal of 2024. The transaction also included an adjacent land parcel valued at 223.4 million, which already has approval for future development. To finance the acquisition, IHH raised RM4 billion through a sukuk issuance at a competitive rate of below 4%. The deal was fully completed on 4 November 2024, solidifying IHH expansion strategy in the Malaysian healthcare sector. So the next part is the reason for the M&A. IHH Healthcare pursued the acquisition of Island Hospital for several strategic reasons. First, the move significantly strengthened IHH's market position in Penang, which is the company's second largest operational cluster in Malaysia. Post-acquisition, IHH now operates 3 hospitals with over 1,000 operational beds, making it the undisputed leading private healthcare provider in the state. Second, the acquisition allowed IHH to capture a larger share of the rapidly growing medical tourism market. Island Hospital currently receives one-third of all inbound foreign patients to Malaysia, particularly from Indonesia, which is a key source market. This gives IHH immediate and direct access to a proven, high-spending international patient base, positioning the group to significantly grow its medical tourism income. Third, Island Hospital demonstrated a strong and consistent financial track record that made it exceptionally attractive target. In financial year 2023, the hospital reported a revenue of 573.8 million a year-on-year growth of nearly 50%, while net profit rose 53.8% to 73.5 million. This momentum continued into the first half of 2024, with profit after tax surging at 54.1% compared to the same period the previous year. Fourth, the transaction included a strategically valuable vacant land parcel adjacent to the hospital. This land already has approval for development, presenting a clear future expansion opportunity. IHH plans to increase bed capacity from the current 600 bed to up to 1,000 bed, ensuring the facility can meet growing patient demand and support sustainable long-term growth. Last part is the synergy received from the M&A. From a cost perspective, IHH can drive efficiencies through unified procurement, standardized protocols, and streamlined management across the group. Since Island Hospital is already well equipped with modern facility and seasoned specialists, minimal capital investment is needed going forward. On the revenue side, Island Hospital generates RM12,000 per inpatient, surpassing IHH Malaysia RM10,700 average. This superior performance is expected to boost the group's overall revenue intensity by 8 to 10%, driven by facility upgrade and higher foreign patient contribution. In terms of market reach, IHH now commands 3 hospitals and over 1,000 beds in Penang, securing its position as the state's top private healthcare provider. Island Hospital 60-40 foreign to local patient ratio and established appeal to Indonesian medical tourists at significant competitive advantage. Clinically, Island Hospital brings 9 centers of excellence and close to 120 specialists to the network, while IHH contributes cutting-edge treatment, system and proven practices. The hospital is Australian accreditation, further reinforce its commitment to global quality benchmark.
Now, I will move on to the financial performance analysis of IHH Healthcare. In this section, we will evaluate the company's financial performance using 3 main aspects: profitability and efficiency, leverage and financial structure, and market valuation. These financial ratios help us understand how well the company generates profit, manages its financial obligations, and creates value for its shareholders. Let's begin with the first section, which is the profitability and efficiency. Next, I will explain the company's profitability and efficiency performance from 2021 to 2025 using 4 financial ratios: net profit margin, return on equity, return on asset, and asset turnover. First is the net profit margin. This ratio measures how much profit the company earns from its total revenue. The margin decreased from 12.71% in 2021 to 9.50% in 2022, but increased significantly to 16.20% in 2023, which was the highest during the 5-year period. After that, it declined to 12.97% in 2024 and 10.30% in 2025. Even though there was a decline after 2023, the company continued to remain profitable. Next is return on equity or ROE. This ratio shows how effectively the company uses shareholders' equity to generate profit. ROE dropped from 6.49% in 2021 to 5.14% in 2022, before improving to 9.12% in 2023. It remained strong at 8.97% in 2024 and then decreased to 9.95% in 2025. This indicates that the company's strongest performance in creating value for shareholders was in 2023. The third ratio is return on asset or ROA. ROA measures how efficiently the company uses its asset to generate earnings. It declined from 3.89% in 2021 to 3.10% in 2022, then increased to 5.88% in 2023, the highest level over the 5 years. Although it fell slightly to 4.97% in 2024 and 3.67% in 2025, the company still maintained a positive return on its asset. Lastly, asset turnover measures how efficiently the company uses its asset to generate sales. The ratio shows an overall improving trend, increasing from 0.376 times in 2021 to 0.460 times in 2024, before a slight decrease to 0.450 times in 2025. This suggests that the company became more efficient in utilizing its assets over time.
Next, we will look at leverage and financial ratio. First is the debt to equity ratio. From the chart, we can see it fell steadily from 0.4 times in 2021 to 0.37 times in 2022 and further down to 0.31 times in 2023. This shows the company was actively deleveraging over these 3 years, relying less on borrowed capital relative to shareholders' equity. However, this trend reversed in 2024, climbing back up to 0.36 times and settling at 0.32 times in 2025. This uptick suggests the company took on more debt financing in the more recent period, likely to fund expansion or acquisition activity, which also helps explain why profitability metrics softened around the same time, since additional debt typically brings higher interest costs.
Next is earnings per share. The chart shows EPS at 20 cents in 2021, dipping to 70 cents in 2022, then nearly doubling to 34 cents in 2023. Its peak for the period. From that, it declined to 30 cents in 2024 and 24 cents in 2025. This mirrors the same rise and fade pattern we saw in the net profit margin, ROA and ROE. Shareholders enjoyed a strong payoff in 2023, but per share earnings have been eroding in the last 2 years. Now, let's take a look at the price-earning ratio, which shows how much investors are paying for each ringgit of the company's earnings. It started at 36.70 times in 2021, stayed similar in 2022 at 36.59 times, then dropped sharply to its lowest point of 70.74 times in 2023. From there, it climbed back up to 24.33 times in 2024 and rose further to 36.46 times in 2025, nearly back to where it started. A higher price earning generally means the stock is more expensive relative to its earnings, and investors are paying a premium often because they expect strong future growth. A lower price earning suggests the stock is more attractively valued relative to what it's earning right now. So the 2021 to 2022 period reflects a fairly expensive valuation. 2023 stands out as the year the stock looked more reasonably priced relative to its earnings, and by 2024 until 2025,
the valuation climbed back to a premium level, suggesting investors regained confidence and were once again willing to pay more for the company's future earning potential. Overall, from the 2021 to 2025, the company went through three clear stages: a weaker 2022, a strong 2023, where profit margins, returns, EPS, and debt levels all looked their best, and then a slow decline through 2024 until 2025 as profits dipped and debt started to rising again. One consistent positive was asset turnover, which kept improving every year, showing the company was using its asset more efficiently over time. In short, the company has strong operational performance and better efficiency, but its short-term financial health has been weakening and needs more attention, especially with debt rising again.
Next, I will explain the defensive tactics used by the target company. In this equation, Island Hospital did not use any defensive tactic because this was a friendly takeover. Both Island Hospital and IHH Healthcare agree with the equation, so there was no need to use strategy like a potion pill or Pac-Man defense. Defensive tactics are usually used to stop or delay a hostile takeover, but in this case, both companies support the details. This equation also gives benefits to both companies. IHH Healthcare expanded its healthy network and strengthened its market position, while Island Hospital received more financial support, better technology, and operational support. In conclusion, no defensive tactics are needed because this was a friendly equation that create mutual benefits for both companies. In my opinion, this equation was a good strategy decision for IHH Healthcare. It strengthened IHH presence in Penang and made it the largest private healthcare provider in state with more than 1,000 operating beds. The equation also brought many long-term benefits, such as access to Island Hospital's strong reputations, advanced facilities, experienced specialists, and international patients. Although IHH faced some short-term integration and financing costs, these challenges are expected to be temporary. Overall, this M&A strengthens IHH market position, support future growth, and creates long-term value for the company and its shareholders. In conclusion, we believe that the acquisition of Island Hospital by IHH Healthcare was a successful and strategic decision. It helped IHH strengthen its market position, expand its healthcare network, and support its long-term business growth. Other days were some short-term costs during the integration progress. These challenges are expected to be temporary. Overall, this friendly acquisition created benefits for both companies and will help provide better healthcare service while supporting Malaysian medical tourist industry.